This is Bart Peterson, and you are listening to Compliance Into the Weeds on the Compliance Podcast Network.
This is Greg Gilchrist, and you are listening to Compliance Into the Weeds on the Compliance Podcast Network.
This is Mike Flanagan, and you're listening to Compliance Into the Weeds on the Compliance Podcast Network.
Hello, everyone. This is Tom Fox. I'm the Compliance Evangelist, back again for another episode. As with me, as always, Matt Kelly, founder and editor of Radical Compliance. And today you are in for true geekness because we're going to take on changes to new lease accounting. Matt wrote a post today, and I have to say, I think I understand it now, but we're going to test that hypothesis. So, Matt, as always, welcome.
Hello, Tom. Good to be here.
So why don't you start us down the road to where we are, where we may be going, and then we can pivot into what the implications might be.
Sure. So this is, I swear, for all the lawyers who are listening, this is going to be a big deal. All the accountants already know this, but there is a new accounting standard for operating leases and how you report the costs of operating leases you sign to your investors and how you put them on the balance sheet. And just so we're clear, an operating lease would be anything like rent for office space, office equipment, computer equipment, data storage. It might be something like a corporate aircraft that you lease from some other person who actually owns the aircraft. There's anything that you would encounter where, number one, you don't actually ever have the option to take ownership of the asset in question. You know, you rent office space, but generally you don't get a chance to buy the building. And number two, your lease period is less than the lifespan of that asset. So you might take a 10-year lease on office space, but the building is going to be there for 100 years. You're never going to have a 100-year lease unless you're a developer in New York or something like that. But that's what an operating lease is for all of that stuff. Historically, the costs that you would incur, they are liabilities, they are debts that your company will have to pay. They are not listed on the balance sheet of the company where all the other liabilities are. They are an off-balance sheet liability, and they can be quite large sometimes, but they have typically only been disclosed in the footnotes as a commitment or a contingency. Enter the new standard for accounting that is going to go into effect on December 15 of this year. For filing periods after that, you're going to have to start listing the leasing costs as a liability on your balance sheet, and you therefore also get to list what you're actually leasing, the equipment, the office space, the plane, whatever. You get to list that asset on the asset side of your balance sheet. And that's coming very quickly. It's got a lot of big implications, but that's what it is.
So that actually sounds pretty straightforward, Matt. But you really point out that this could have some, I don't want to say catastrophic results, but it certainly can make a company's balance sheet look very different. And I'm going to start with Potbelly Corp, because you cited to it in your blog post today. And Potbelly currently has $289 million in leasing liabilities, will have $289 million in leasing liabilities, with having had $428 million in revenue in 2017. What is this going to do to companies that could companies potentially find themselves underwater to start with, or their leasing liability could increase multiples of hundreds of percent?
They could indeed. And in fact, I'll stop you right there, Tom, when you said that Potbellies will have liabilities up to $289 million. No, they do have leasing cost liabilities of $289 million. Those are leasing contracts with somebody's signature on them. And they're already there. And that's where suddenly you start to maybe think, whoa, boy, wait a minute. We've got how much that we're putting onto our balance sheet right now. And in some cases, it can be a lot of money. The key determinant is to express it in relative terms. what are the liabilities that the company has on the balance sheet right now? And maybe they are $100. And what are the additional leasing liabilities we're going to bring onto the balance sheet? It could be $20. It could be another $100. It could be hundreds of dollars compared to the 100 that you have. And that is exactly the situation that Potbelly is in. I got this data from CalcBench, and they are a business partner of Radical Compliance. We work together a lot. We were looking at which companies have the largest relative increase in leasing liabilities. And Potbelly's is number 2. 5-Star Senior Living is, I think, a nursing home chain, but 5-Star Senior Living is number 1 among all the 3,500 companies we looked at. Their liabilities are going to go up by 456% when they bring all of their leasing costs onto the balance sheet. Potbelly's is going to go up 447%. We found, I think, about 25 companies where their leasing will double the size of the liabilities on their balance sheet, at least, if not triple or in some cases here quadruple. So what does that mean for some practical consequences? Well, it could trigger a debt covenant that maybe your organization has, and then suddenly you either have to renegotiate the debt covenant, perhaps at higher interest rates. In the worst cases, the lenders could decide to force you into bankruptcy. I don't think that's going to be a common occurrence, but just goes to suddenly show to people there are going to be real practical consequences to this leasing accounting change. So right away, we see compliance concern number 1. Companies are going to need some sort of assurance that they know about all the operating leases that they actually have. Because you could have some vice president of operations in the Southern Cone division at the tip of Southern America signing some great operating lease obligation that you don't know about, and you don't find out about it until like 3 days before the end of the quarter or 3 days before you're filing the 10K. You're in a mess if that happens because you have to rejigger everything. It could trigger a debt covenant, and now everybody's in an uproar. So that's going to be, I think, one part policy management and one part training of telling operating executives who might be signing leases in your facilities or your real estate department, don't do this unless you tell us. Make sure we have a system so that when you do it, we can capture it and we can track it. So it's one part policy management, one part training, one part document management. And in a perfect world, you would even want to change the technology that you use to sign and execute and track all of your contracts so that you are not transcribing these values from one spreadsheet to another, as we're never supposed to do, but somehow they get machine read into a finance system that your financial department might run so that you can pull up all of your leasing exposures all at once and you can see what are our total liabilities? Is this going to trigger anything? If we sign this new lease in Australia, down in Florida, up in the mining rights in the Ukraine for the next 10 years, is this going to somehow change our balance sheet operations and our equations there? All of that is going to have to be considered, and companies are working their way through it. But this is still a learning process for a lot, especially for the smaller companies, and that's a concern that we have.
So you took the blog post in a way or a direction rather that certainly I was not anticipating because I thought kind of the first section certainly was straightforward around the accounting requirements and then turning it into or pivoting, as you noted, into policy management, document management, and training. But then you brought up the issue of the assets because if you're going to throw in all of these liabilities, there probably needs to be an offset on assets. So why don't you take us through that? Because some of the collateral issues I thought about when I read that section, I just frankly can't stop thinking about now.
Sure. So this is down to the basics of accounting. And for anybody who is not an accountant, I promise I will keep this simple. All of the company's assets must equal all of its liabilities plus shareholder equity. That's the equation. Assets equal liabilities plus shareholder equity. So we're dumping a whole lot of liabilities onto the balance sheet with this new accounting change. All right, that's fine. And then so I actually asked one of my accounting professor friends, what gets added on the balance sheet to offset all of that? He says, well, you get to add in the value of the asset that you're leasing. What is the value of that airplane or that data storage or that office space that you're taking? That gets listed on the asset side. The leasing expense is on the liability side, and whatever's left over is shareholder equity, and then we all get so thrilled and the stock price goes up. Here's my concern, is that the expense, the lease, the liability, the price of that is fixed. It's in the contract that you signed. That's not going to change. The asset that you are now listing that you get to own, it does have a certain value, and maybe at the start it is equal to the expense you've just listed. But over time, that asset might change in value, and then you could find yourself underwater. Now, I'll give you a hypothetical, and I'm not picking on potbellies, even though they might seem like the hypothetical I'm about to give. Let's say you are a restaurant chain, big fast food chain, and you signed a bunch of 10-year operating leases in shopping malls all over the country in 2013. And you have that expense, you have that liability, that's fixed. Well, the asset that you are listing now are all of these fast food restaurants in shopping malls all over the country, where you are selling your greasy food and your high-fat hamburgers and all of that stuff. Then what happens? Well, Amazon and Walmart come in and start saying, we're going to deliver everything to everybody. You never need to go to a shopping mall again. And foot traffic is declining. And meanwhile, everybody says, I'm also going to start eating my healthy living now, and I'm never going to go to the fast food joints again, whether it's Potbelly's, McDonald's, Burger King, or my hypothetical business. So suddenly, all of the anticipated value you were going to get from that asset of owning or leasing space in restaurants or restaurant space and shopping malls all around the country, that's not necessarily the same value you thought it would be in 2013. But here we are in 2018, and we are struggling with shopping malls that don't have anchor tenants anymore, and foot traffic is down, and people's tastes are changing and evolving away from the high-fat, high-salt, crappy kind of fast food that people used to buy in the 80s and 90s. So you might have that asset not worth the expense that you're listing. So this is my question now to accounting people, auditors in particular, would be, how are they going to assure the value of that asset? Now, you could ask people for more documentation. This is not brain surgery. This is what audit firms already do with companies for things like goodwill and inventory and revenues and all this other stuff. We've never done this with operating lease assets and liabilities before. This is new. And now that they're on the balance sheet, this is going to be a whole lot more high profile. So you, the compliance person, you, the financial audit, the financial compliance person or the internal auditor who's listening to here, you might have to start thinking, well, if the audit firms start giving me more grief for more evidence and documentation on the value of these assets, do I have that? Because they've never asked it before, because it's never been on the balance sheet before. But now it is. But that asset has to equal the value of the lease expense. And if it doesn't, something has to get marked down, but it can't be the liability because that's in the contract. That can't get marked down. The only thing that gets marked down then is shareholder equity, and now suddenly everyone's in an uproar. That's my question, is how often will we see this dynamic manifest? And we don't know right now, but it could.
So let me change your fast food hypothetical just a bit. And say you're a major manufacturer of motorcycles, and because of a change in import duties, you move to begin manufacture these motorcycles outside the United States in Europe. And the president attacks your company via Twitter for being un-American and unpatriotic. And that causes your motorcycle sales, a large number of whom sales are to supporters of the president, they abandon you and they go to another motorcycle manufacturer because you're unpatriotic and you're not making America great again. Do you have to now make that sort of determination on leases as well, or could it impact the lease valuation?
Well, in your specific situation, probably not, because most companies in that situation wouldn't have operating leases. Those would be more like capital leases, which are already on the balance sheet and they're treated differently. Or they might just own their manufacturing outright. But to the broader question of, could external forces change the value of the asset you are leasing, the public perception of it, and cause it to decline? But you can't therefore then suddenly write down the rent that you want to pay to your landlord because people aren't coming into your store anymore because nobody goes to shopping malls. We just have it all delivered by drone, by Amazon or Walmart. Could there be external forces that pressure the asset in ways that we're not used to? Yes, that's true. Could those pressures include short-sighted political proclamations by a certain president in the White House? Theoretically, yes, it could. This is not necessarily news that assets listed on your balance sheet might not be worth what you say. That is exactly what happened in the 2000s with the financial crisis, where we had derivative assets and mortgage-backed securities that everybody said was worth everything and exactly what we thought, right up until we all realized this is baloney, and we've been baloneying ourselves for 5 years. These assets are worth crap, and then suddenly the banking system seized up. But we worked through that with the valuation of derivative assets. We've worked through it, or there is a system to work through the value of goodwill and intellectual or intangible assets on your balance sheet. Now we're coming to the same process for operating equipment. Companies do have a lot of operating leases floating around. Potentially, these things are billions of dollars. In fact, CalcBench did a study that the average S&P 500 firm that has some sort of leasing liability, its average is $1.3 billion. Now, there are a vast majority of smaller firms out there that have a smaller leasing liability, but on average for those smaller firms, it's about $105 million. They looked at roughly 3,000 firms that are not in the S&P 500. So there's a lot of value tied up here that is suddenly getting dumped onto the balance sheet in two different places, and it's supposed to equal out. And most times it will. However, one of them, which is the asset, has more susceptibility to being reassessed and revalued or even impaired than the liability, which is the expense, and just that's in the contract, and that is what it is, and that ain't going to change. And that's where we are.
So in one paragraph, you suggested that companies may need to consider perhaps changing their leasing policies to include emergency exit clauses or clauses where rent depends on other performance metrics. When I read that, Matt, I immediately thought of negotiating on behalf of a landlord. And if a landlord accepted those clauses, is a landlord's 10-year lease now a contingent asset that they can't record the as an asset because it's contingent even upon an exit clause or some other performance metric? And what are other collateral potential results that we either are known knowns or known knowns or unknown unknowns at this point?
It's all a very good question that has to be worked out. And in most of the time, I think it's going to be worked out between the company, its lessors, and if it is leasing equipment, its lessees and your audit firms. Because theoretically, from the landlord's perspective, the lease that they are giving you isn't like, it's a liability for you, but it does not actually necessarily exist as an asset for them. For them, it's a revenue stream. But if they gave you some sort of contingent rent clause, then for them, they get into these very tricky questions about revenue recognition that, Tom, you and I talked about a couple of months back there, that this could be a variable interest, I think it is, asset where, the value of the revenue might fluctuate based on circumstances you cannot easily predict at the time. That's not impossible to work out, but it's going to be difficult to document. It's going to be difficult to figure out with your audit firm. It's going to be tricky to put into a corporate filing. It's going to be tricky for SEC, Office of the Chief Accountant people, to read through and kind of figure out how are we going to handle various situations. This is a learning curve. I don't think either the SEC or the audit firms or the PCAOB, the audit firms regulator, I don't think any of them are looking to beat companies over the head with these two new standards that are colliding at once. The leasing standard right now and the revenue standard that did go into effect at the start of this year. But both of them, these are two very complicated forces that are landing on corporate balance sheets in a relatively short period of time. Even if we figure out what is the theory of this, how are we going to account for all of these things? Compliance officers, financial compliance in particular, financial planning and analysis firms, departments, they've got a whole lot they have to think about around documentation, document management, and internal control strategies for all of this to make sure that you have a complete picture of what's going on to apply to whatever theory we might have ultimately figure out for this, which we haven't entirely done yet. And so it's going to be a party.
So you conclude, Matt, with a short discussion on return on assets. Can you walk us through that?
Yeah, this is more of a tertiary sort of wrinkle to what is already a very wrinkled up subject of lease accounting. But so return on assets, if you're a financial analyst, you look at this a lot. That is a measure of corporate profitability where net income is divided into total assets. People express that as a percentage. The higher the percentage is, the better the company's ROA is. And roughly speaking, that means the better it is at converting money it invests into profit. But this is all, remember what we said here, this is net income divided into total assets. And now we're dumping a whole lot of assets onto the balance sheet, which are all of these leasing things that you have. So if you are adding more assets, the denominator of this equation, and I promise on my blog post, I've got all of this neatly laid out in cool little graphics. But if the denominator gets larger, that means your return on assets is going to fall. Well, it might look then at first glance like, oh my God, the ROA went from 5% to 3.5%. That's a nightmare. But not necessarily, because all we did was just add a bunch of assets that we already had. They were not on the balance sheet, but they were there. We've put them on the balance sheet. So this is just an accounting trick, has suddenly changed a financial metric that a lot of people use to value companies. So now what do compliance officers have to worry about here? Probably not that much, but investor relations people, we're definitely going to have to think about how do you explain this change so that investors don't have a heart attack because they don't know what's going on and they think ROA has fallen. These guys must be a bunch of yokels. Let's dump the stock. That's a totally wrong way to interpret it, but it wouldn't be the first time investors have totally interpreted something totally wrong. So that's another thing that we're going to have to work out. In theory, you might also see some executive compensation tied to return on assets. I don't know how often that happens, but it could. Probably more for senior executives than anybody else. Therefore, if they might have incentive to game ROA, and you'd have to think about, is there potential for misconduct there so they can hit a performance goal? I haven't done enough research yet to know if there's a lot of that potential actually there, but that is something that CalcBench and I are going to kind of crank up on to see if the return on assets dimension to all this might also be a big thing, because it is a key metric of profitability, and we're going to change it solely through an accounting quirk, not through any change to the actual operations of the business.
So, Matt, unfortunately, we're near the end of our time, but I'd like to end this podcast the way you ended your blog post, which reads, Lots to think about, as you can see from this post. Implementation starts in 4 months. So if your organization hasn't started thinking about it yet, you may want to get to that. Excellent post, a great discussion, and I think this is one we are going to be able to continue the conversation on, Matt.
All right. Thank you, Tom.
Hello, everyone. This is Tom Fox. Thanks again for listening to this episode of Compliance Into the Weeds. If you have any questions on today's podcast, you can email me at tfox@tfoxlaw.com. If you have any questions of substance, you really should email Matt after reading his post. He's available at mkelly@radicalcompliance.com. For those fans of Compliance Into the Weeds, we're developing a mailbag episode, so if you have any questions you'd like us to take a deep dive into, please email myself or Matt. Thanks again for listening. I hope you'll join us again next week, where Matt and I will go into the weeds to discuss a compliance topic. Compliance Into the Weeds is a part of the Compliance Podcast Network.